So let's look at someone, who's watching this show and who's never invested in mutual funds, is considering investing in mutual funds right now. Obviously, he doesn't have any concentration or diversification, or hopefully he's sorted on his asset allocation. And let's just stick to equities. What would you tell him or her in terms of how to choose a mutual fund to start his investment journey?
When it is about starting an investment journey, so I'm going to use the recommendation of having a trusted financial advisor as a base. It's a foundation, I think, for a lot. Not to say that people can't do it on their own, and there's a lot amongst the young generation in the DIY stage where they would love to do it on their own. So for those who are starting, I think that what I would advise is to simply think about time frame. What is the time frame that they're thinking of when they are putting their money to work? Is it just that they want to upgrade their mobile phone every second year, let's say? Is it that they want to buy a house, or most people may not want to buy a house or own a car these days, but is it that they want to start a business 10 years from now, right? A startup of their own that they want to do. Is it that they want to backpack and roam the world when they're 35? What is it? What's that time frame?
Okay.
And then many of them are getting settled. So when are their kids going to get into education? When are they going to stop work and think of doing something as their passion gig for the future? Things like that. Once you get your time frames aligned, equity works best for the longest of the time frames. Anything, I would say, which is 5 years and above is good for 100% equity allocation, so to speak. Within that, you can decide with your advisor or without your advisor. I would prefer with your advisor how diversified or concentrated or themes or whatever it is that you want to do. It is really when you're thinking about time frames below the 5 years and then thinking about investing into equity that I think that you should apply a little bit more caution. Because your time frames, if they're shorter than 5 years, I would probably say that better bets are to go for blue chip portfolios, the large companies that don't get very volatile. Even better would be go for multi-asset portfolios and hybrid portfolios that the mutual fund world today offers. So if you're getting this auto asset allocation within your funds, or you're going for hybrid funds which are not 100% equity funds, you're in a very safe zone, and you will still make I would say a decent return compared to leaving that money in a bank, which should be your frame of reference. So the first aspect is time frame.
Time, always.
The second aspect is, what are you using as your benchmark for comparing your performance? Are you using your neighbor as your benchmark? Are you using your friend's fund as the benchmark, or stock as the benchmark? Or you're using the fact that if I didn't do anything, this money would be in the bank. What would I get in the bank? That could be your benchmark. For many people, it would be, if the market, the index is doing something, then that's my benchmark. Choose it wisely. Because most often, if you're choosing the benchmark as saying, well, I think the equity market in the last 2 years has done 50% and that's my benchmark, keeping that expectation for the future can lead you down the wrong path. So I think choosing the benchmark. So you get your time frame right, choose your benchmark, and then even if you're doing it yourself, you use your hybrid funds for things in below the 5 years, and more equity funds beyond the 5 years. Mix up the styles. Don't think something is bad or good just by looking at the face of it. And final underlying, get a good trusted financial advisor who's qualified, who's certified to help you along the journey. That would be even better.
Folks, that's as comprehensive as it can get. So don't just go on performance. There's an entire framework that Ajit has just mentioned, and you can just rewind this and hear it all over again.